Hello, everyone, and welcome back to LexiMind, the channel where knowledge meets language learning.
That's right. If you're new here, this is the place where we dig deep into amazing books, discuss the big ideas inside them, and at the same time, we teach you real, useful language that you can actually use in your everyday life.
I'm Mary.
And I'm Lucas, and today we have an absolute page-turner for you.
Imagine it is October 1987. You are just sitting in your living room, watching the evening news, and you suddenly realize that a massive chunk of your life savings is just gone.
It just vanished in a single afternoon.
Right.
Exactly.
And your first instinct, like anyone's is to run. You want to sell whatever you have left just to stop the bleeding.
Yeah, it is a terrifying thought for most people. I mean, watching your own money drop like that. It really tests how we handle fear.
It really does. And today we are debating a concept that goes against every survival instinct we have. When it comes to building wealth over your lifetime, is the absolute best secret just, doing absolutely nothing?
Right. We're looking at this really interesting tension between keeping your finances incredibly simple versus the harsh reality of market crashes.
Yes. And the core of this discussion comes from a framework that argues for extreme simplicity. I am taking the side that keeping things simple, specifically by just focusing on 5 main lessons, is the best way to gain financial freedom. And lesson number 1 is that money is just a tool. You have to master it, or it masters you.
And I completely agree that money is a tool. But I argue this extremely simple strategy leaves regular people really vulnerable. But let's start with that first lesson, mastering the tool.
Right. So level 1 thinking is where most people live. They see money only as a way to buy things today. But if you shift your mindset, you realize money is just a tool to buy your freedom.
Yeah, the financial industry makes it seem so complicated, right? Like you need a degree just to understand it.
Exactly. They want it to be confusing so they can charge you fees. But mastering the tool means avoiding their traps. Which brings us right into lesson 2. Debt is your biggest enemy.
Oh, absolutely. I mean, if investing is compound interest working for you, then debt is
It is reverse compounding.
right. It just destroys your future to pay for your present. Think about a credit card mistake. You buy a TV on credit, and suddenly, you are paying for that TV for 5 years.
And you pay double the price in interest. So step 1 is paying off that debt. But once you do, how do you invest? This is where we might disagree. Lesson 3 is to keep it totally simple. 1 index fund is enough.
Yeah, this is where it gets tricky for me.
Well, the strategy says you just buy a total stock market index fund, like Vanguard's VTSAX. You own a tiny piece of every public company in America, no picking individual stocks, no expensive managers, just one fund.
And look, avoiding high fees is smart. For every winner in the stock market, there is a loser. But where I push back is the idea of putting 100% of your money in stocks. I mean, expecting a regular person to just hold 0 bonds and write it out when the market collapses, that is asking a lot.
But that is exactly what lesson 4 is all about. The market always goes up eventually. You just have to stop trying to time it.
Over 100 years, sure, it goes up. But let's look at a normal human lifespan.
Okay, let's look at it. If you put $12,000 into the S&P 500 in 1975, it grew to over $1 million by 2015. That is just math. Yes, the journey is scary. We had the 2008 financial crisis. Global banks almost failed.
Which was terrifying.
Totally. The fear makes you want to sell. But the whole foundation of this simple path is accepting that crashes are just the price of admission. If you panic and sell, you lock in your losses. You just have to ride it out.
See, ride it out sounds so easy in theory. But we have to look at the worst case scenarios, right? Look at the Great Depression in the 1930s. The market didn't just drop 20%. It dropped 90%.
But nobody invests all their money on one day right before a crash. They do dollar cost averaging. They invest a little bit from every paycheck, month after month.
Assuming they still have a paycheck.
Fair point.
I mean, imagine telling someone who just lost their job in a depression, who is watching their life savings disappear, to just keep buying stocks. Human beings have something called loss aversion. We feel the pain of losing money twice as much as the joy of making it. When the market crashes, our brains react like we are being chased by a bear.
But that panic, that very human panic, is exactly why extreme simplicity is a shield.
Wait, how is a 100% stock portfolio a shield?
Because complexity gives you buttons to press when you get scared. If you have 10 different funds and gold and bonds, you start tinkering. You sell this, you buy that, and you always time it wrong. If you only own one fund, you are in a behavioral straitjacket. You just hold it.
A straitjacket only works if you don't unbuckle it when the house catches fire.
Well, it takes discipline. But all of this discipline leads to the final most important goal. Lesson 5. Build your FU money, freedom money.
Ah, FU money. The ultimate dream, right?
It really is. Have you ever heard the story of the monk and the minister?
I have, yes.
It perfectly captures this. Two friends grow up. One becomes a monk, the other becomes a wealthy minister for the king. They meet years later, and the minister sees the monk eating a plain bowl of beans. The minister says, if you just learned to serve the king, you wouldn't have to live on rice and beans.
And the monk replies, if you just learned to live on rice and beans, you wouldn't have to serve the king.
Exactly. FU money is the freedom to walk away from a toxic boss, a bad job, or a life you hate. And you get there through the 4% rule. You just save enough so you can withdraw 4% of your money every year, and it lasts forever.
It is a beautiful story. But my major issue is that actually living on that 4% in retirement is not simple at all.
Why not?
The math says it works.
Because of taxes? The government does not let your money sit in retirement accounts forever. Once you reach your 70s, they force you to take money out, and if you aren't perfectly managing which account you pull from, like doing a Roth conversion ladder, you can get hit with a massive tax bill. You have to use spreadsheets and track tax brackets. It is highly active management. Okay, yes, tax optimization takes some work, but honestly, managing a tax spreadsheet once a year is nothing compared to the stress of trying to predict the stock market. People fail because they buy expensive cars on credit or they panic sell during a crash. The simple, one-fund path solves 95% of the problem.
But that remaining 5% is where people can lose their life savings. Simplicity is a great ideal, but having a mix of assets, maybe some bonds, is the only real safety net against the unknown.
Well, we clearly have a line drawn here on how much risk a person can handle. But before we do our final summaries, I think it would be really helpful to pause and clarify some of the vocabulary we've been throwing around today.
Oh, definitely. Finance has so much jargon, it is so easy to get totally lost. Let's break down maybe 4 or 5 words we just used.
Great idea. Let's start with the word accumulate.
Accumulate.
Right. So in simple English, to accumulate just means to gather or collect something over time until you have a lot of it.
Exactly. So in investing, you accumulate wealth by saving a little bit of money every single month. Like she started saving in her 20s and managed to accumulate a large retirement fund.
Perfect. Okay, here is the second word, volatile. We talked about this one a lot.
We did. Volatile basically means likely to change very suddenly or extremely, usually in a bad way.
Yeah, I always think of it like a really bumpy car ride. The stock market is volatile because prices can shoot up or drop down completely without warning. Like, the stock market has been very volatile this week because of the bad news.
Right. Which leads perfectly to our third term, ride it out.
Oh, my favorite. Well, to ride it out means to just endure a difficult situation without trying to stop it, trusting that it will eventually end.
Like staying on a roller coaster. You can't jump off in the middle, you just have to ride it out. So you could say, the economy is bad right now, but investors just need to ride it out.
Exactly. Okay, word number 4, compounding.
Compounding is like magic. It basically means earning interest on your interest. So your money starts making its own money.
Think of a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow and gets bigger and faster. So, thanks to the power of compounding, his small investment grew into a fortune.
Love that. And let's do one more, the ultimate goal, financial independence.
Financial independence. This simply means having enough wealth to live on without needing to work for a paycheck.
Right. It is the freedom money we talked about. Like, after paying off all her debt and saving for 20 years, she finally achieved financial independence.
Perfect. I think breaking those down makes the whole strategy much easier to grasp. So, keeping those ideas in mind, let's wrap up our debate. From my side, the hyper-simplified one fund approach is the most powerful tool ever made for normal people. It overcomes debt, it bypasses the greedy financial industry, and it lets the math of compounding do the work.
And I will summarize by saying that minimizing debt and avoiding expensive advisors is brilliant. We agree on that. But human beings are just not spreadsheets. We feel pain, we panic, and we have complex tax laws to deal with. I think a truly robust strategy needs to account for human weakness, rather than pretending extreme simplicity cures everything.
It really forces us to evaluate our relationship with money, doesn't it? Whether we can just live simply and buy our freedom, or if we need a softer landing. There is so much more to explore here, and ultimately, everyone has to decide what level of risk they can truly stomach. Thank you for listening to The Debate.